At Iron Financial, this is the only place where we forge stronger portfolios by putting market narratives under some serious stress. Today, we are putting a titan under the microscope, Mastercard. Their latest earnings just dropped, and, the headline numbers, they look like they're forged from pure steel. But we go deeper here. We're here to answer one simple question. Is this company really a financial fortress, built to withstand any economic storm, or is it just a house of cards, beautiful to look at, but one stiff breeze away from total collapse? Let's get to work. Okay, so let's just dive right into the official story here. Management is painting an absolute masterpiece. You hear it right there from the CEO, Michael Miebach. He says, another strong year. Net revenue up 16%, well-positioned for the opportunities ahead. I mean, come on. This is exactly the kind of confident, forward-looking statement that the bulls just eat up. It sets the tone, doesn't it? It just screams stability, dominance, and, of course, continued growth. They're basically telling the market, hey, the machine is running perfectly and we're about to hit the accelerator. Whoa, hold on a second there. Of course that's what the CEO is going to say. I mean, it is literally his job to sell the story, to paint that rosy picture. But our job here at Iron Financial is to pop the hood, kick the tires, and check the foundation for any cracks. Because that's the real question, isn't it? Corporate optimism is cheap. Economic reality? Not so much. So before we get all swept up in the C-suite's narrative, we have to ask ourselves, is this fortress as impenetrable as they claim? Or are we maybe ignoring some serious warning signs? That's a fair point. You're right. Talk is cheap, but you know what? Numbers don't lie. So let's do this. Let's ignore the talk for a minute and build the bull case brick by brick, using nothing but the hard data from their own filings. We are going to examine the structural integrity of this company, and it all starts at the top line. The raw, unadulterated power of their revenue engine. Let's really dig into these numbers. Okay, just let this number sink in for a second. 18%. That is the year-over-year net revenue growth for the fourth quarter. You have to understand, in this economy, for a company of this absolutely colossal size, just hitting double-digit growth is impressive. But hitting high teens growth, that is a straight-up demonstration of pure market power. This isn't some hot new startup, right? This is a global behemoth that is somehow still finding ways to expand its empire at a truly staggering pace. And look, that 18% isn't a percentage of some small number. We're talking about a base of $8.8 billion in net revenue in a single quarter. Think about the sheer scale of that operation. Every single day, this company is processing a massive torrent of global commerce and taking its cut. The scale is just immense, and it provides this huge base from which to generate incredible profits. This is the heavy lifting of the global economy, and Mastercard is sitting right there in the middle of it all. And here it is. This is the punchline. This is the number that separates a good company from a truly great one. 25% adjusted diluted earnings per share growth. Now think about what that means. Revenue grew 18%, but profits per share? They grew even faster. That, my friend, is something called operational leverage. It means that as more and more revenue flows through their system, a larger and larger chunk of it drops straight to the bottom line. The machine isn't just big. It is becoming more and more efficient with every single transaction. So let's put it all together now. Just look at this table. To me, this is a beautiful piece of financial machinery. Net revenue up 18%, hitting $8.8 billion. But look below that. The adjusted operating income is up 21%. See that? They're growing the bottom line even faster than the top line. And how are they doing it? Look at the adjusted operating margin. It actually expanded by 1.4 percentage points to 57.7%. So what that means is that nearly 58 cents of every single dollar of revenue becomes operating profit. This isn't just a company. It's a cash-minting fortress. This is the very core of the bull case. Powerful, scalable, and increasingly profitable growth. And this chart here, this brilliantly illustrates exactly where that growth is coming from. Think of these as the three main load-bearing pillars of the business. So first, you've got gross dollar volume. That's the total value of everything bought with their cards. And that's up a healthy 7%. It shows the consumer is still out there spending. Second, switch transactions. That's the raw number of times a card gets used, is up a really solid 10%. This is the bedrock of their volume, the fundamental activity. But the real kicker, the high-octane fuel for their profit engine, is that bar in the middle, cross-border volume, up 14%. We're talking international travel, e-commerce across borders. It is one of their most lucrative, highest-margin segments, and it's growing at double the pace of domestic spending. Every one of these pillars is strong, and every one of them is growing. Okay, that is a very pretty picture. I'll give you that. A powerful fortress with some really strong pillars. But you're standing there admiring the architecture of the skyscraper without even bothering to check the weather forecast. And from where I'm sitting, I see storm clouds gathering on the horizon. Looking only at a company's past performance in a vacuum like that is one of the fastest ways to lose your shirt in this market. You have to look at the environment it's about to operate in. So let's talk about those headwinds. This slide right here really shows the core conflict, the whole debate in a nutshell. On the left side, you've got the company's internal metrics, right? All green arrows pointing straight up, everything we just talked about. But on the right, you have the external reality, and the global outlook is flashing all sorts of yellow and red warning signs. A fortress is only as strong as the ground it's built on, and right now, the global economic ground is starting to look pretty shaky. The bull case lives inside the company's report, the bear case lives out here in the real world.
And, the real irony here is you don't even have to take my word for it. Let's look at what Mastercard's own economists are saying. Yeah, the Mastercard Economics Institute is forecasting a slowdown. Global real GDP growth is expected to moderate, that's their word, in 2026. Now, it's not a crash, but it is a deceleration. The tailwind that's been lifting all ships for a while now is starting to fade. And when the global economy slows down, consumer and business spending inevitably slows down right along with it. And Mastercard, they are the ultimate toll booth on that spending.
Now, this slide shows the hidden volatility that most people miss. See the gray area? That's the total amount being spent. And yeah, it's still high. That's what the bulls love to focus on. But I want you to look at the yellow bars, which show the year-over-year change. See what's happening on the far right of the chart? We're actually seeing negative bars pop up. The rate of growth isn't just slowing down. In some recent months, it's actually started to decline. This could be a huge leading indicator. It's like the canary in the coal mine, and it's suggesting that the consumer strength that powered those fantastic Q4 numbers might be starting to fracture. And these right here, these are the cracks in the global foundation, and they're pulled directly from Mastercard's own economic outlook. First, you've got that moderating global GDP growth we just talked about. Second, new inflation risks coming from tariffs, which could squeeze consumer pockets and mess up supply chains. Third, there's the potential for economic overheating in some parts of the world because of fiscal stimulus, which sounds great until it leads to higher inflation and big debt problems. And finally, you've got diverging policy paths, different central banks all doing different things, and that just creates a ton of uncertainty and volatility. This is not a stable, predictable environment. It's a minefield out there. A minefield? Maybe, but I think you're seriously underestimating the durability of this machine. A fortress isn't built for calm seas. It's built to withstand a siege. These headwinds you're talking about are real, I'll grant you that. But the real question is whether Mastercard's core business, its growth engine, is strong enough to just power right through them. You see cracks, I see a structure that was built with redundancies. Let's analyze the engine itself and see just how durable it really is when it's put under stress. Just look at this data. This right here is the monthly heartbeat of the company. Focus on one line with me, switched transactions. Now look across the row, from Q3 all the way through to January of 2026. What do you see? 10%, 10%, 10, 10, 10, 10. It is an unbreakable steel frame of consistency. This is the core utility of the business, the sheer number of times people are tapping and swiping and clicking. And it is rock solid. That's the foundation you're so worried about? It looks like bedrock to me. But wait, you're just cherry-picking the most stable metric on the whole table. On that exact same slide, let's look at the more profitable, more sensitive numbers. Look at cross-border volume. It went from 15% growth in Q3 and November down to 14%, and now it's sitting at 13% in January. That is a clear deceleration in their highest margin business. And now look at the US market, specifically US switched volume. It fell from 8% in Q3 down to just 5% and has been stuck there for months. The engine is still running, sure, but it is clearly losing RPMs in some key cylinders. That's not strength, that's fatigue. Fatigue? Or just a shifting gears? Even if growth moderates a little bit from these stellar levels, you're forgetting the final and, maybe the most important part of the equation for an investor. What is the company actually doing with the mountain of cash it generates? How are they forging direct shareholder value? Because when the market gets choppy, capital returns can act as a really powerful anchor. Let's talk about the payoff. This is what that 57.7% operating margin produces. In a single quarter, we're talking just 3 months, Mastercard returned over $4.2 billion directly to its shareholders. Now, that's not a projection, that's not a promise, that is cold, hard cash. $3.6 billion in share buybacks, which juices earnings per share for everyone who remains, and nearly $700 million in dividends. This is the ultimate proof of a business's health, its ability to generate way more cash than it needs and then reward its owners. And you know what? They are just getting started. This is not a company that's running on fumes. They have $16.7 billion remaining under their current share repurchase authorization. Just think about that for a second. That is an immense war chest. That is heavy artillery that they can deploy to support the stock price by just buying back shares in the open market. So if the market gets nervous about those economic headwinds you mentioned and the stock dips, management has the firepower to step in and create a solid floor of demand. That is a massive safety net. A safety net? Or maybe just a way to mask slowing fundamental growth. It's time to weigh the evidence. We've looked at the bull case, which is built on the company's incredibly powerful performance, and the bear case, built on a deteriorating global outlook. So let's put them side by side and deliver the final iron financial verdict. Okay, the bull case, what we call the forge, is crystal clear. You've got ferocious double-digit revenue and EPS growth. You've got industry-leading operating margins that are expanding to nearly 58%. And underpinning all of it is that consistent, rock-solid 10% growth in transactions, plus a massive shareholder return program. But on the other side of the ledger, you have the fracture. The global economy, the very foundation this entire business is built on, is slowing down. We're seeing volatile consumer spending trends, and there's a clear deceleration in their high-margin cross-border business. And you simply cannot ignore the geopolitical and tariff-related risks that add a thick layer of uncertainty to absolutely everything. So here it is. Here's our verdict. Mastercard is, without a single doubt, a financial fortress. The numbers are just undeniable. The profitability, the scale, the brand, that creates a deep, wide moat that protects it from the competition. It is a fundamentally superior business. However, no fortress is an island. It is subject to the world around it, and the macroeconomic tides are clearly shifting. Investors cannot ignore the growing signs of a global slowdown. The company is incredibly strong, but the environment is becoming more challenging. To own this stock is to bet that the strength of the fortress can withstand the rising storm. So we'll leave you with this final thought to chew on. Mastercard has built the best, most profitable toll road for global commerce the world has ever seen. But the ultimate question for any investor has to be this: what happens to the toll collector when the traffic starts to slow down? That's the risk you have to weigh. That's all for this edition of Iron Financial. Do your own homework. Forge a stronger portfolio. We'll see you next time.